Hey traders, Raghi here, and in this video I'm going to talk about some timing, and this is specific to the non-farm payroll event that we had today and the way in which we want to put our order. So there's a couple ways we can do this, so I want you to think about this the next time you're dealing with any kind of what I call hot zone, and that is a high impact economic event. And I call those hot zones. Now, how do you know what these high impact economic events are? You can take a look at the economic calendar. I like the one over at Forex Factory, and I'll utilize the timing of those economic events to expect when the volatility is going to increase. So we did that with the US dollar Canadian dollar. Now that applied to the US dollar Canadian dollar Forex, but that also applied to the CDZ futures, which is really one and the same in terms of the symbols. I mean, it's both US dollar and Canadian dollar. And in the case of CDZ, it's the futures. And in the case of US dollar Canada, it's the Forex. And they're inverse because of the order in which the two currencies are quoted. All right, so I've kind of got currencies on the brain because tomorrow we have a big event here in Dallas, and I've been talking about it for a couple of weeks. We're going to be doing a full day Forex event here in Dallas, and that's going to be here at the Reunion Hyatt here at Reunion from 10 to 5. We're hoping to record it, but no promises. Hopefully you guys can make it. It's going to be a great show. Let's talk about some of these currencies though. So Canadian dollar, what we did in terms of the timing was this. We had the US hot zone by way of NFP, and we also had the jobs numbers come out of Canada, and the market made its reaction. Now, both the US dollar and the Canadian dollar were competitively strong for a brief amount of time. Now, the US data on the surface, on the headline number, looked pretty bad, a big miss on the actual NFP number, the headline number, but then the average hourly earnings and the unemployment rate were actually really good. So we waited for the market to deal with that data, and we waited for the market to test this resistance level that was based upon the previous Darvas 2.0 here, and we waited to see if the market could really catapult higher through that or if it was going to exhaust. And when we gave the market time to settle down and we watched the price action chop around near that exhaustion level that was visible on the daily, we decided, you know what, it's safe to go in, and we went ahead and took the short off that overbought buy. So in this case, a lot of traders are always asking me, Rog, can we get into these markets before? And the before is the big bet. The big bet meaning if we're right, you get a huge payoff immediately. It's like betting on the right horse, right? Well, I want to, in the rush that comes with that, but I want to go after the volatility. Sometimes that's after the big move. But the big move in this case isn't about betting on which direction the market may move before it happens. It's about using the move after the fact to see where the market has landed after the fact. That's really, really, really what I want to emphasize here. Those after the fact moves are so seldom used because people think the big move on economic data is the volatility that the release triggers. But in reality, oftentimes I find that to be more a risky proposition. What I prefer is to do what I call catch the wick. And that means wait for the volatility to move the market to a level that you're interested in. Not benefit from the movement, because that's really a gamble, but did the market volatility carry you to a level that you would like to buy or sell at? A good example of that is Euro US. We had projected a 65 to 55 low. Now, this is a tricky conversation because there were a couple different levels that were viable here, and some traders took those levels and got long on that move. We were looking for 65 to 55 for a catch the wick, park our limit order in that area. And we actually made a low of 68, I believe it was. Where was that low? 68. So you can see it just skimmed the 65, which was a price movement based low. But for traders who are looking for the previous Darvas lows to hold, they did a pretty darn good job. And here we are rallying from 68 up into 117.35 as Friday winds down to a close. So what I want to mention here is this was not about guessing the direction of, let me show you here, these candles. It was about where do these candles land us, and does that number mean anything to us where we would get in? This is the safer way to go. This is the catch the wick opportunity that I'm talking about. Not guessing that we're going to move lower sharply and buy or sell in this area here, because we could have done this as well, and that would have hurt, right? But rather, once the market's made the move, does this move mean anything to us and give us an opportunity? That's what Catch the Wick is all about, and that's how we played today. So I wanted to cover that in today's recap video. Hopefully you'll think about that the next time you have a hot zone that you're dealing with, the next time you have an economic event that ultimately you think could create a trade for you, and think about the after the fact opportunity.